Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending April 26th, 2024. I am host of InvestTalk, Justin Klein, and today's video is going to be titled Housing Market Retrenches Due to Higher Rates as the Fed is on Deck. And we'll dig into the economic data real quick, as well as talk about the Fed announcement coming up next week, and then dig into the charts. So, the economic data this week was on the lighter side, but because next week is heavy with a lot of economic data, and this previous week is retail sales. You had reaccelerating, excluding motor vehicles. That did pretty well. Motor vehicle sales are not doing so hot. You see that with what's happening with Tesla and a lot of the EV makers. And then you just get higher rates, and higher rates are certainly weighing on the auto market. But outside of that, spending remains relatively robust. But when it comes to housing, those higher rates are weighing on activity. And what you can see here is that 2 out of the last 3 months are now in negative territory for housing permits. That's saying that the home builders are feeling like they have enough inventory and they don't really need to start pulling permits to build more. And so that was down month over month by 4%. And then more importantly, housing starts. So permits are just plans. Starts are actually, hey, we're putting workers on the job to actually make those homes come to fruition. And so when housing starts are down 14, so nearly 15% month over month, that is a pretty big drop. And then, if you look at over the last 3 months, you have 2 out of those 3 months down pretty big. So, overall, this is not a good sign for the housing market. Obviously, with mortgage rates heading back, let's see what we're at. I usually go to mortgage rates daily. Mortgage, I think it's mortgage news daily. There we go. There we go. That's the one I usually go to. And this gives you a pretty good overview of what's happening at 3.45 is where we're at on mortgage rates. So, yeah, so here's 30-year fixed. Yeah, 30-year fixed up now towards 7.5%. And that is weighed on the existing home sales as well. And that's for the month of March. That's not including this latest month. So if March was negative 4%, what do you think April will be? So certainly the housing market, when it comes to demand, is those higher rates are weighing on demand even more than they have been. Now, does that mean the housing market's going to crash? No, there's still relatively low inventory levels across the board. Some markets are starting to see some more intensified weakness, but for the most part, in most markets, it's still kind of a seller's market. Okay, industrial production that came out. I believe that was Wednesday, and that came in about flat, same as the previous month. So that was the economic data. Obviously, we have next week is May. April's pretty much over with now. We only have 2 more trading days in the month of April, and then we have the first on Wednesday, and that means the Fed meeting. Fed meeting, and this is the May meeting, and it's the first of May. So the Fed meeting actually starts on Tuesday, and they announce it on Wednesday. And there's basically a 97% chance that they will do nothing. They will not cut rates, but we know that ultimately the Fed meetings are never about what are they going to raise or lower rates. It's always about what they say about future path of policy. And in today's world, it's not just about rates; it's also about QT. Okay, are they going to wind down QT at some point? It seems like they are setting the stage for that at some point this year. But obviously, with inflation the way it is, they're not in a huge hurry to or drop QT. But we know with the amount of debt that's out there, the issues with. I'll show you this real quick before I move back. But the move index did start to move up earlier this month. Now it's come back, and that's a positive. So that might give them some room to maneuver and push the end of QT off a little bit farther. But this is what I will be watching next week on the Fed meeting: is the market look kindly to the path of policy, and not just rates, but also QT for the Fed. And then also the Treasury quarterly funding announcement that happens sometime next week. I forgot the date, but that's something to be watching for as well. And whether the Treasury starts issuing more, uh, we call them notes versus bills. Bills are on the short end, notes are on the longer end. And so whether they continue to focus on the short end, that would be good for asset prices, good for liquidity. If they start to issue more on the long end, that would be bad for liquidity and asset prices on the margin. So there's some big announcements coming up next week, and so I expect volatility potentially both ways to pick up. But I don't think we're gonna have a flat week. Let's just say that. Now, the expectations for the Fed rates going out, you still have a pause basically in June. Remember, a month ago, we go back down a month ago, there was about a 64% chance we were going to get a cut by June. Now that's down to about a 10% chance. So the market is pretty much priced out a rate cut completely uh, by in June. July, there's still a little bit of a chance, but September is kind of the base case now of when they will cut rates. You now have about a 55, 58% chance of a rate cut by September. And then December, it's kind of coalescing around the one and a half, about one and a half rate cuts. So that's probably more accurate. I think 1 to 2 rate cuts is probably what you should expect for the rest of the year. But once again, that is not the most important factor in policy going forward. It's really about how can the Fed continue to how can they continue to finance this amount of debt, the Fed and the Treasury, and they're kind of working together in that sense. And then here is the 10-year Treasury bond ETF. You see that's coming down. That means rates are rising. So what's interesting here is the TNX chart. This is not updating. It stopped updating in April. I'm gonna have to figure out a new symbol or what happened with those charts, but this is closer to 4.75 on the 10 years. So we're creeping back up to that 5% range that we were at earlier, or sorry, late last year. Now let's take a look at the broader indices. Here's the S&P 500. We pulled back to support. We pulled back to the 2-5 retrace right around 5,000 and the 100-day moving average, and we got a bit of a bounce. Now, it's not a strong bounce. It's a bit of a bounce. You definitely had a mixed picture this last week when it came to earnings. Obviously, Tesla and Microsoft went up, and then what was the other? Oh, Netflix, I believe that was that was down. Meta was down as well. So, kind of a mixed bag. You had Google that was up. Tesla got a bit of a bounce. Microsoft that did get a bit of a bounce, but faded. Look at this fade really throughout the day. So certainly a mixed picture when it came to earnings, at least for the mega cap tech names. Overall earnings are actually pretty robust. They're not, I wouldn't say robust. They're pretty solid based on what's been announced and expectations. About a 3% year-over-year earnings growth. So not a bad place to be. Not amazing, but certainly we're not in an earnings recession. Now here are the Qs. The Qs did get a bit of a bounce as well. Let me run a quick fib on this. Yeah, so that actually got closer to this 382 retrace and tells me you're actually probably going to get down there. And that's kind of what I'm expecting. I do expect this to be kind of an ABC pattern. And you had the first A leg. This is the B leg, which is a little bit of a retrace, but we're probably not going to get much higher than this. Okay. And then we get another leg lower. I think 4,800 in this area is that buy zone where, okay, we've had that requisite pullback that kind of refreshed sentiment a little bit. And that could be that start of that next up leg. But that might not bottom until June sometime, and we're just starting to get into May. So don't think that this is going to turn right away. And I think there's still some volatility left in markets. And you can see that even with, just I zoom in on the technology sector, which we know is a big part of the broader markets. That has clearly rolled over. You're getting a mini bear flag, and so I do think there's a continuation here sometime in the month of May. The VIX has pulled back. Now that is positive, but obviously now in an uptrend. And the VIX is notoriously volatile, but a higher VIX is obviously poor for equity markets. Now, the reason I say this is probably not anything to worry too much about is this. Here's the short-term junk to short-term treasuries, and what you can see is this is an uptrend. So you've had a little bit of pullback, which means credit spreads have widened out a little bit, but from very low levels. They're not breaking down. There's nothing really to worry about here. This is just normal market volatility seasonally. Obviously, the market's adjusting to a Fed that's a little bit less dovish than the market was expecting going into the year. And so, what sparked this rally in last fall? The basis of that is I wouldn't say crumbling, but certainly weakening to a decent degree. And so it's fair to get a bit of retrace in markets overall, but there's still good liquidity out there, and it's probably not something that is going to create any major issues that you want to be going all the cash or anything like that. Now, what I will say is there's probably one part of the market that is the scariest, shall we say? And that would be the JGB market and the yen. The Bank of Japan has moved off zero rates, and they are positive, but they're barely positive. And so, what you see is that interest rate differential continues to march higher. Here's obviously the 10-year. Like I said, this is closer to 4.75, and the 10-year or the Bank of Japan has their short-term rates at I think it's 1 basis point, something like that. And so that interest rate differential is causing major weakness in the yen. And so they have two choices, and none of them are good. They either raise rates in order to uh, in order to strengthen their currency, but they have so much debt that creates a debt spiral. Okay. Um, think of what are debt issues, but on steroids. And Japan has had giant debt problems for a long time, and it's just only intensifying. So they could do that, or they can continue to keep rates where they're at, which is the path they are going down, and that's going to mean the yen is likely headed lower, which means inflation in an economy or in a country where they have to import a lot, right? They're a group of islands, and so there's not a whole lot of uh, domestic natural resources and goods being produced there. Even though they're a big economy, a lot of what they do is intellectual property. Think of Toyota and Honda, and they don't produce a lot of Toyotas and Hondas in Japan. They produce them a lot in places like America. So, the issue that Japan has is both demographics, right? An old population, and a ton of debt to support that population. And so, the big question, I think the big risk, let's just say the big risk that's out there is, what if they want to support the currency without raising rates? What do? Very simple. They're going to have to sell dollar denominated assets and buy yen. Okay. And remember, Japan is a big buyer of treasuries. So if this gets unorderly, what are they going to need to do? They're going to need to step in, sell treasuries, and that could spike the treasury rate. Here's the move index, right? The move index moves, it goes up. Talk about that 150 level. We're still far away from that, but you can see this can move pretty fast, right? It already moved from mid 80s all the way to 121 in the span of 2 weeks. So could we go from 100 to 150 in a matter of 2 weeks? Sure. I don't see any reason why we couldn't. So something I'll be watching, with the confluence of events next week, the Fed announcement, the Treasury refunding uh, announcement, and then what's happening with the yen. All of those factors combined could create major issues with the Treasury market and spark that next leg of the downturn. Now, What I think is going to happen is the Fed will use any potential crisis there, just as they did back in the fall of 2022, to pivot. Back then, we had problems with the JGB market, that's the Japanese government bond market, as well as the UK gilt market. And behind the scenes, they did things to weaken the dollar and support those markets. That's the situation we're in. We are in the popping of the global sovereign debt bubble, and Japan is the first one that is probably going to fall. It's just the question is, what is the broader ramifications as that happens, and how do they manage to kind of kick that can down the road? And that's what governments are likely to continue to do for years to come. When I say we're popping of a sovereign debt bubble, doesn't mean that has to happen overnight. Doesn't have means it has to happen this year. It's probably going to be a multi-year process as this plays out. And so um, these are the main factors I will be continuing to watch. And I think that's another reason why you continue to see gold prices headed higher. If the global sovereign debt is coming into question and the safety of that, what is the next safest asset? And that is going to be gold. It just has so much monetary history. And this is a breakout that still has room to run. Obviously, pulled back a little bit this week, but no problems here. And even the miners, those continue to be strong as well, right? A little bit of pullback and a rally as we closed the week. So a lot going on in currencies, and I do think gold should be considered as a currency. Now let's take a look at the broader commodities market. Here's the Dow Jones UBS Commodity Index, and this is in an uptrend now. Pretty much the month of March broke that downtrend, and we continue to consolidate. Pretty much all of the back half of April has been this consolidation period where I expect it to move higher. So harder assets are certainly becoming more in favor. Now, growth to value, that ratio continues to run out of steam here. Let's go to a weekly chart. And we've talked before about 2022 was that period where value drastically outperformed growth, and then 2023 you had that rally until the end of the year, and then started this year you had a rally in growth for just a handful of weeks, and since then value has been outperforming. And the week before last was a big reversal. Now a little bit of bounce and growth this week, but overall I still think this is headed for a rollover, especially if you get a breakout in those commodity names. So I'll be watching that and seeing where that ratio, those style factors, kind of trend. What else do I want to get to? Let's look at the industrial space. Industrials did pull back, but look at the strength of this. I mean, this is just a modest pullback. Look, the broader market is got close to the 100-day moving average. This didn't get close to that. The tech space, obviously, well below the 100-day moving average, and so those at the bottom here, and didn't even close above it this week. I don't think we did. So the industrials continue to do well, and you're seeing some relative strength there. Materials historically very volatile, but that still remains in a solid uptrend. Let's look at energy. XLE, just a bastion of strength there, despite the recent pullback. And here's the USO. So we're seeing a lot of strength out of those harder assets, and I think that will continue as we get into the summer months. So yeah, that's where we're at. I would say I'm neutral to bearish near term, but medium term I'm still bullish because we're still in an uptrend, people. Let's pull. We can even go to the VTI, right? VTI, Vanguard Total Stock Market Index. Let me clean this up here. This is just the 100-day moving average. But you typically get, when you get these overbought scenarios, you typically get a pullback into the 382 retrace. And this makes too much sense kind of to get there. based on the catalyst over the next month or so, as well as this consolidation period. Look at this consolidation period. That would be major support. That doesn't mean we have to get down there, but if we get down there, that's certainly a buy. And even the 50% retrace, I still think this would uh, be considered a continuation of the broader uptrend, and no major change to this uptrend really until you get below this 225. Below that, that's when you say, okay, the nature of the markets have changed. The nature of the markets have shifted. That uptrend is gone, and we are now in a protracted downtrend. So, while people might freak out about this pullback, these things are healthy. These things are healthy. And the backdrop of liquidity remains robust with the TGA still at very high. I think we're at $700-800 billion. We have the treasury, or we have the RRP reverse repo. I think that's still around $300-400 billion. And so there's no issues here with liquidity, and so there's no really reason for this pullback to become protracted. It's just needed, and it's seasonal, and it's a readjustment of expectations of Fed policy going forward. So that's where we're at. I appreciate you all tuning in and liking and subscribing to this channel, as well as our podcast, InvestTalk. And a reminder that the content of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.